Today, we're going to talk about securities lending and digital assets. What is at stake? Digital asset issuance is growing. All major custodians are currently building the capability to custody them. The equity and debt capital market divisions of major banks are working with issuers. Banks and exchanges are building infrastructures for them. New regulations around the world, like the DLT pilot regime and MiCA in Europe, will provide regulatory certainty. At the same time, you have the fast-paced development of decentralized finance, largely outside the traditional financial markets. In this context, the International Securities Landing Association, ISLA, has launched a working group. The current objective is to ultimately allow digital assets to be used in securities lending transactions. Just as an introduction on securities lending market size, there is about 2.8 trillion of assets, equity or bonds, on loan at any given time, and it generates 4.8 billion euros in revenue for the lenders. If you have to compare it with a new decentralized lending business happening on blockchain, the long-established securities lending business is broadly 300 times bigger. The first deliverable of this working group was published recently. It identifies the changes that will need to be made to the Global Master Securities Lending Agreement, also known as GMSLA, to allow the market to use digital assets, either as the asset loan or as collateral. It has a broad coverage of digital assets, including securities issued as digital token, traditional securities that are tokenized, cryptocurrencies, non-fungible tokens, and stablecoins. It also covers securities that are issued through the traditional routes but settled through DLT-based infrastructures. The key considerations explored are: how do you orchestrate the title transfer between the lender and the borrower? And, for instance, what events are actually considered as a delivery? How do you terminate effectively a transaction involving a digital assets in case, for instance, of a default? How do you protect the interest of the lender when collateral in form of digital assets is pledged instead of being physically transferred? How do you cover specific matters like voting, corporate action, etc.? How do you maintain the economics of a deal when the assets are digital assets? It covers considerations related to airdrops, staking, hard forks, applicable to non-securities token. It also covers the fact that due to the nature of digital assets, business days or close of business terms are not relevant, and the current securities lending agreements should find alternatives for those terms. How do you implement collateral management with digital assets? What could be the other routes for securities lending of digital assets? The GMSLA is the current framework used by securities lending and borrowing desks around the globe. It is designed for traditionally held assets in a CSD and with traditional custodians with traditional processes. Therefore, the ISLA initiative is welcome because it opens to digital assets, the current securities finance market. However, a completely new legal and operational framework may also emerge independently of ISLA and independently of the GMSLA. Decentralized finance, also known as DeFi platforms, may be better suited to the specific attributes of digital assets. The ability to have smart contracts managing collateral pools and default events, and the ability to compose programmatically multiple DeFi processes and actors without any human coordination would be a great advantage. What a bank could do to leverage the working group initiatives? Well, a great ambition for a bank could be to execute the first ever securities lending transaction involving a digital assets under the GMSLA framework. To support this ambition, there is a need to ensure that, for instance, the digital asset custody infrastructure deployed covers legal and operational needs of a securities lending deal, such as pledge, collateral posting, recall, etc. There is also a need to make sure that the digital assets include all the required events. And to be more specific, the smart contracts must all have the function required to support a securities lending transaction. And third, all parties of a deal must be comfortable from a legal standpoint with a digital asset-friendly GMSLA. Stay tuned on this topic, it will evolve fast.